It's good to have you with us, as always, on a day that will be dominated by the interest rate expectations in the United States. The first big story of the morning is tied to the rate story in this country. In the past 30 minutes, the markets have been reacting to the latest numbers on retail sales in Canada. A fairly muted consumer spending picture in this country seems to be building the case for more rate cuts ahead from the Bank of Canada. Now, let's start with what we know for sure. June was a fairly lackluster month on the retail front. Month-over-month sales down roughly 0.3%. When you add that into the overall retail sales story for the second quarter, it was a negative stretch after a negative first quarter. In fact, outside of the pandemic, it's the weakest two consecutive quarters we have seen on retail sales since 2009. Now, there were some preliminary numbers shared from Stats Canada suggesting July saw an uptick in sales. But the overall cooling in spending, coupled with that cooling we told you about earlier this week on the inflation front, seems to suggest our central bank remains on track to lower borrowing costs for a third straight meeting coming up on September 4th. Let's kick off our coverage this hour with some reaction to the numbers. Don Desjardins is the chief economist at Deloitte Canada and one of our regular guests. Don, it's great to have you with us on this busy Friday morning.
Thanks.
What did you think of the retail sales update today?
Well, I think we knew it was being telegraphed. We had those preliminary numbers suggesting it was going to be weak. And it is the good side of the economy. We also spend on services, and there we may see a little more joy. But nonetheless, it does suggest that the Canadian consumer is cautious at this point. Yes, inflation pressures are easing, but interest rates are still relatively high. And I think that is really damaging confidence.
So does a report like today's build the case, in your opinion, for another interest rate cut by the Bank of Canada when they meet next month?
Absolutely. I do think. I think we've seen the inflation data sufficiently slowing to support the case for a rate reduction in September, and probably a couple more as we end out the year. But this just adds, I think, just a little bit more. When we're looking to the data that the bank will have in hand, when they do meet on September the 4th, they will have the second quarter numbers for the total economy. They're looking for growth about 1.5%, very much in line with what we have. The add up of the GDP monthly numbers suggests something closer to 2%, but that's always completely accurate. But nonetheless, we're growing at a rate that's less than the economy's potential, which suggests there's excess capacity. And that could put further downward pressure on inflation.
And how much of that is because of where interest rates have been? It's one of the considerations. It's the main consideration. How have you viewed this interest rate environment and the impact on where the economy is itself?
Well, certainly it is constraining people when we look at real interest rates. So we know inflation rates are coming down, but the policy rate is coming down as well, but just more slowly. And so real interest rates, the real impact on how people live, that is still very restrictive. And I think from the point of view of the bank, they're seeing a labor market that's losing a little bit of its luster. Our unemployment rate has risen, and we know a lot of that has to do with labor force growth rather than sharp job cuts. But still, softening in labor markets, that too is going to absolutely have an impact on consumer spending.
I've heard a lot of our guests say, for example, for those who are gainfully employed right now, where there has been for a lot of people, the ability to hold on to your job, even if there's not a lot of new job creation. But I suppose if that were to change, that would be a negative signal for the broader economy.
That would definitely be, I think, a bit of a game changer in terms of the economy. And we don't really see that. But when you look at surveys, what companies are saying, they're saying, not expanding, but really not looking at cutting at this time, which is a very good signal, I think, for the economy to continue to grow, maybe not rapidly, but grow.
Yeah, that's what I was going to ask you. Like we tend to find a bumper sticker term to define the economy for better or for worse. So if we're talking about worries of a recession versus the prospects for like a so-called soft landing, a couple of common terms we use, are you saying it's looking a little bit more like a soft landing scenario than a recessionary scenario?
Yes, we do believe that we have avoided, very narrowly, but we've avoided a recession in 2023. And we think we're going to continue to see the benefits of falling inflation, as well as lower interest rates. And those two, we think, should insulate the economy sufficiently that we don't go back into that very slow growth mode.
So when we're trying to think, you mentioned interest rates, so let's just try to give our audience a picture of what happens from here. We've seen 2 consecutive meeting cuts. This data today is building the case for a cut at the third meeting in a row. Beyond that, how are you thinking about what the Bank of Canada will do on rate policy?
Well, we think that they're going to continue along this path of 25 basis points move, not seeing urgency that they have to move more aggressively. Because I think if they start to go in increments of 50, for example, it does suggest a little bit of panic. And we don't really think they're panicked at this stage. It's more now trying to work in a way that the economy is able to continue to grow, but still moving that policy rate slightly lower. And that will sow the seeds for a better growth outlook for 2025.
And I guess the market has had some time to think about this. So assuming you don't get data points to take us too far off course, I mean, I was mentioning that the Canadian dollar this morning has been stronger against the greenback when there's a takeaway that would suggest that rates are going down. Theoretically, that's the kind of thing that can work against a currency, but I suppose we had already seen a lot of weakness in the loonie. Is that a consideration?
I think it's also the changing attitudes and expectations for the U.S. Federal Reserve. I mean, definitely the tide has turned significantly over the past few weeks, and that has taken a toll on the U.S. dollar. In fact, some are looking for a 50 basis point move in September. Now, that's not totally priced in, but arguably, if we're going to start to see the Fed move, and we know markets are extrapolative, once they see once, they're expecting much more. So the markets themselves have more rate reductions by the Federal Reserve by the end of this year compared to the Bank of Canada. And I think that's what's giving that lift to our currency.
All right.